In this presentation, I want to walk you through an interesting move in the Bitcoin Treasury world this year, a joint study announced by Metaplanet and 3 partners into digital credit. It sounds technical, but the core idea is simple and powerful. Before we begin, I would appreciate it if you could hit the like and subscribe button to support my channel. Thank you. This presentation is not financial advice. Here's the question that frames everything. Most companies that hold Bitcoin treat it like a savings account. It just sits on the balance sheet. But what if Bitcoin could do more? What if it could become the foundation for an entirely new credit market? That's the shift this announcement points toward. And for any shareholder, the test that matters is whether this direction increases Bitcoin per share. On the 10th of July 2026, 4 companies agreed to jointly study the digital credit space using Bitcoin, stablecoins, and security tokens. Those 4 are Metaplanet, Metaplanet Securities, JPYC, and Progmat. Now, one honest caveat right up front. This is a study. There's no product yet, no terms, no yield, and no timing. Think of it as a serious research memo, not a signed deal. I'll keep coming back to that because it matters. Before we go further, 3 quick definitions. First, digital credit. Credit just means lending, bonds, loans, preferred shares that pay a fixed return. Digital credit moves the ownership record and the payments onto a blockchain. Second, a security token. That's a regulated on-chain version of a financial security, tracking who owns what. And third, a stablecoin, a token pegged to a currency. In JPYC's case, the Japanese yen. It lets cash move on the same rails as the token, so interest can be paid instantly rather than days later. It's tempting to reduce this to preferred shares, but that undersells it. Metaplanet already runs a whole toolkit it calls its digital credit strategy. There's Bitcoin-backed debt, ordinary bonds, a convertible preferred called Mercury, an adjustable rate preferred called Mars, plus lending and tokenized securities. The guiding rule is elegant. At any moment, choose the instrument that raises money while doing the most for Bitcoin per share. Let's zoom in on Bitcoin bonds because they're central to this study. A Bitcoin bond is a corporate bond where Bitcoin plays a defining role. Either the money raised buys Bitcoin, or Bitcoin itself backs the bond as collateral. Strategy, formerly MicroStrategy, pioneered this using convertible bonds. Metaplanet already does a version of it today, issuing ordinary bonds and borrowing against its Bitcoin. The frontier this study targets is the digital version, a tokenized, Bitcoin-backed bond that settles on-chain, around the clock. So who does what? Metaplanet brings the Bitcoin balance sheet and the creditworthiness of a listed company. Metaplanet Securities, formerly SIBO Securities, is a licensed securities firm that handles structuring and distribution. JPYC provides the yen stablecoin that moves the money, and Progmat provides the token infrastructure. Each party owns one piece of the puzzle. The most unfamiliar of them, and arguably the most important, is Progmat. So let's spend a moment there. Progmat is not a Bitcoin company. It's the regulated infrastructure that lets Japanese financial institutions issue digital assets on a blockchain while staying inside the law. It started as a project inside Mitsubishi UFJ Trust and Banking, part of Japan's largest bank, MUFG, and was later spun out as an independent company, backed by the country's other major banks. The way I'd put it, Progmat isn't the train, it's the track. Everyone else runs their products on top of it. And here's the key point. This machinery already works at scale. Progmat's largest and most successful segment is tokenized real estate. There have been more than 70 tokenized property offerings in Japan since 2021. The flagship was an Osaka skyscraper, tokenized by MUFG for 22.4 billion yen. Together with one competitor, Progmat's rails handle over 90% of Japan's security tokens. So the question this study really asks is, can those same proven rails now carry Bitcoin-backed credit instead of buildings? This all sits inside Metaplanet's Phase 2 and a strategy called Project Nova. Picture a flywheel. You stack Bitcoin, that treasury plus the platform generates revenue. The revenue funds preferred dividends. Stable dividends let you issue more credit, and the proceeds buy more Bitcoin, which lifts Bitcoin per share. The deliberate shift here is away from selling common shares and toward Bitcoin backed credit. The stated ambition 210,000 Bitcoin, about 1% of all the Bitcoin that will ever exist by 2027. Here's the mental model I keep returning to. Instead of Bitcoin sitting idle, it becomes collateral that backs and strengthens the instruments built on top of it. Think of a fully paid off house. You can let it sit, or you can responsibly borrow against it to fund something productive while still owning the house. In this world, there's even a nickname for it, the volatility refinery. Common shares absorb Bitcoin's wild swings, and preferred instruments turn that volatility into a steadier stream of yield. Now for the most technical phrase in the announcement: daily prorated distributions. Traditionally, whoever holds a security on one specific record date gets the entire period's payment, even if they bought it yesterday. That creates distortions and price jumps. Daily accrual fixes this. Interest builds up a little each day, credited only for the days you actually held it, just like a savings account. Because value accrues smoothly, the instrument can trade any hour of any day. There's a live example in the United States. Strive's preferred, called SATA, began paying dividends every single business day in June of 2026. That's the reference point Metaplanet is pointing to. So why is this a study and not a launch? Because Japan's systems were built for periodic, fixed-date payouts. The Companies Act, the shareholder registry, the book entry infrastructure, they all assume dividends happen on set dates, not continuously. To get daily accrual and around-the-clock settlement, you need per-holder tracking, which the security tokens provide, plus on-chain cash movement, which the stablecoin provides. That bridge between the old system and the new one is exactly what these four companies are trying to build. Could anyone else in Japan copy this? Let me give you both sides. The case for Metaplanet's moat is collateral. A Bitcoin-backed instrument is only as sound as the Bitcoin behind it, and Metaplanet holds 43,000 Bitcoin, while a typical bank holds almost none. Banks also face harsh capital rules for holding crypto, which Metaplanet, as an operating company, avoids. But, and this is the honest counterpoint, the infrastructure is shared and open. Banks could distribute these products or lend against Bitcoin without owning any. So my read is, this is a real but time-limited first mover advantage, which is exactly why Metaplanet is racing to widen its lead now. Let me bring it back to the shareholder. The appeal is that credit, bonds, and preferred funding let you buy more Bitcoin without issuing new common shares, so Bitcoin per share can rise instead of fall. That's what can support a premium valuation. The risk is equally clear. Bond interest and preferred dividends are hard obligations, and they bite hardest when Bitcoin falls. My overall take: the direction is genuinely compelling. Bitcoin as productive collateral, funding a whole family of instruments, moving Metaplanet closer to something like a Bitcoin bank. But nothing is built yet. The moment to watch is when this moves from study to proof of concept to real issuance. Thank you for listening. A quick disclaimer: this reflects my own research and opinions, and it's for information only. It is not financial advice. Markets are risky, I can be wrong, so always do your own due diligence and speak to a licensed advisor before investing.